Should we buy or sell this industrials ETF? First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. Okay, so industrials is under, industrials in the sectors, and this is the, US industrials ETF. Though many of the companies in this ETF, they are very big, so they have a global footprint as well. 21% from the 52-week low, approaching an 5-ish% pullback. Okay. Interesting to note, there are some of these ETFs that are in bear market territory, minus 31% here. This one is very close to bear market. This one is approaching bear market territory, minus 16%. So there are things happening here that is not fully reflected in the major indexes. Here is the XLI weekly data points, and we have seen a very substantial rally. As of late now, let's actually measure for how long. But we have basically been consolidating now for 224 days. That is quite significant. The saying is, the longer the consolidation, the bigger the breakout, or the breakdown. So in this video, we have to kind of figure out what is most probable, a breakout or a breakdown. If we look at some previous consolidations, so we had this period here, no progress for 273 days, and then breakdown. In this instance over here, so you can see that this ETF has a bad habit of consolidating, basically. So here we just have a fake breakout, basically, because the sell-off was, pretty substantial. Yeah. Okay, let's go to the daily data points. So here we do have an interesting situation. So let's load the moving averages. I think you can see yourself that we do have the very important red 200-day moving average. It can be resistance, but most of the time for this one it has been pretty decent support. You see that we are testing it a bit more vigorously as of late. If we look and zoom in a bit here, you can see that we rather recently had this. This was dangerous. You see what happened here? This is the kind of price action you want to see as a bull. Basically that, the support level works as a support, but here you can clearly see that the bears are making progress. Then we have a bit of a rally, then the bears are back here again. And we closed surgically at the red 200-day moving average. So this is another ETF where we have this make or break situation. Does it mean that we're going to completely implode if we close below? No, but if there are bulls out there, we would expect them to buy this key support level. There's no reason to expect there to be more bulls below the 200-day moving average. That's not how moving averages and support levels work. The bulls are, supposed to buy here. So yeah, that's critical. So from a technical standpoint, I would lean bullish, but it is completely contingent on that moving average holding. It is way too important. Now looking at these other indicators, we're very much in this neutral zone here because of this long-term consolidation. When we go here to the daily data points, it is a bit of an ominous signal that accumulation distribution actually went down. We would ideally, we would want to see some kind of pickup. Given that we have been dancing around the 200-day moving average now for some time. So to see that there is this selling pressure here, notwithstanding support, it really shows us that the bulls are not really grabbing this opportunity. That doesn't mean that all is lost. It does, however, mean that the probability for the bears to do damage now has increased. Looking here at the last 5 years of seasonality data. You see here that January, February, March, it's a more mediocre period over the last 10 years. So January closes higher 50% of the time, 1.4% average gain. February, however, is strong. Over the last 20 years, which gives us more data, we do see that January is one of the weakest months. It's the second weakest month. The only weaker month is June, with a minus 0.8% average loss, minus 0.6 here for January. Going here to Finviz, we do have the trend lines that potentially could offer support if we lose the 200-day moving average. Looking here and comparing the S&P with the XLI. So looking at the price earnings ratio, the XLI does have a 4.8% higher price earnings, but not really that much. I mean, that is modest. The dividend is almost identical. And, the 1.23% dividend is it's not anything that will make people hold on to the ETF just, to get that amazing 1.23% yield. Here are the holdings. Industrials, it's one of those, it's a bit of a peculiar sector because you have, Caterpillar, and then you have these military companies. It's a bit, it's a bit of a hodgepodge, really. Here you can see some sector breakdown, market cap breakdown. Let's jump to the correlations. So there's a 94%, well, 95 actually, kind of strong correlation with the S&P 500. Long-term weekly data points, minus 11% with the 20-year Treasury bond ETF, 41% with gold, and minus 69% with the dollar index. Daily data points. Then we have 46% with the SPY, minus 4% with TLT, 45% with gold, and let's call it 8% with the dollar index. So to sum up my take here, given that we are at support, I will give the benefit of the doubt to the bulls, but that is completely contingent on the 200-day moving average, because the seasonality here is a bit ominous.